Hey traders, let's get real about backtesting. It's a must-do for anyone crafting a trading strategy, but it's not as easy as it sounds. A lot of folks mess up in backtesting, which ends up costing them big time when they hit the real markets. We've talked a bunch about backtesting before, how it's useful, and how you can use it to fine-tune your strategies. But today, we're gonna focus on what not to do. You don't want your strategy to turn into a money pit, right? Before you dive into backtesting, let's get a few necessities down. First, use a big chunk of data for testing. Make sure you have a solid trading plan set up first. And don't forget to include some rules for managing your risk. These steps will help keep your strategy and account in good shape. Now, think of backtesting like keeping a trading journal. It's super important to write down everything, your backtesting results, how you did the tests, all that sort of stuff. And after you've done backtesting, take some time to really dig deep into the data. This helps you tweak and improve key parts of your strategy, like the risk-to-reward ratio, how much you might lose before you win, how much you might win before you lose, what your win rate is, your good and bad streaks, the drop in your account, like maximum drawdown, and so on. When you're ready to start backtesting, be aware of some of the common mistakes. Doesn't matter if you're new to trading or a pro with fancy tools. These errors can really trip up anyone. To make sure you avoid them, let's have a look at what they are. The first culprit on our list is the look-ahead bias, which is like trying to cheat in a test by sneaking a peek at the answers you'd only know tomorrow. In backtesting, it's when you use info in your strategy that you wouldn't normally have while trading. Imagine using tomorrow's stock prices today to decide what to buy. It just doesn't work like that in real life. The mistake often happens when you accidentally include a stock or a currency in your strategy that's been doing really well lately, like a stock index right before a bull market or a currency pair that's been on a strong trend. But here's the catch. You wouldn't have known that they were gonna do so well when you started trading. Your strategy might fall flat in the real market because it's based on hindsight. To dodge this trap, make sure your backtesting covers a longer period. That way, you're not just banking on recent successes, but testing your strategy in different market conditions. The next culprit on our list is optimization bias. Optimization bias is kind of like fine-tuning a car to work on a specific track. It might actually do really well there, but once you get it to different tracks with varying conditions, it'll not perform as well. When backtesting, you might keep adjusting your strategy to make it work perfectly on historical data. And that seems like a good idea, right? But you're basically just tailoring your strategy to fit that specific set of data, not to succeed in the ever-changing real market. One way to steer clear of this is to simplify your strategy. Test it out in its basic form across a bunch of different instruments. If you don't want to go that route, another good move is to extend the time period you're testing. Say your strategy looks great over the past 2 years. Try stretching that period to 5 years or even more, and if it still holds up, you're on a better path to success in real trading, where changing conditions are always present. And the third major mistakes you guys make is when backtesting, you're ignoring the influence of the real market. And that can be broken down into 3 parts. The first one is psychology. Many traders fall into the trap of thinking that their real trading results will mirror their backtesting outcomes. But the reality is often quite different. When you're backtesting, emotions aren't in the picture. You're making controlled decisions in a calm, controlled environment, opening and closing trades at what seems like the perfect levels. However, in the heat of the moment, emotions might play a big role. They might lead you to close profitable trades too soon or to adjust your stop loss when it's not really needed. The emotional side of trading can significantly impact your decisions and, as a result, your trading performance. The second thing is expenses. Another common issue is overlooking fees, spreads, slippage, and stuff like that in your backtesting. This can be a big deal, especially with less liquid instruments where spreads or slippage can be pretty hefty. These costs might turn a trade that looked profitable in backtesting into a loss in the real market. While you might not notice much difference on a single trade, over time, these overlooked costs can lead to a big gap between your backtesting results and what you actually experience in live trading. The long-term impact of these factors can significantly alter the effectiveness of your strategy, so make sure you do your research before you start. And the right time to trade. When backtesting, it's easy to overlook the fact that many of your profitable trades might have happened at times when you wouldn't actually be active in the real markets. It's important to remember that trading isn't just about strategy, it's also about timing. You might be asleep, at work, or otherwise occupied during the key trading hours that your backtesting suggests are most profitable. Additionally, significant market movements often occur during major economic announcements or the release of important macroeconomic data. These moments can create volatile conditions where executing trades in real time may not be as straightforward or even feasible as your backtesting results would suggest. This factor needs to be considered when evaluating the viability and potential success of any trading strategy in the live markets. And lastly, you need to remember the market is a living organism. When you're backtesting, think of the market like a constantly changing beast. What worked like a charm 10 years ago might not cut it today. So keep that in mind and tweak the time period of your backtesting to match today's market as closely as you can. Also, remember that even if you're testing your strategy on just one thing, like a stock, it's still getting nudged around by what's happening with other stocks or even totally different stuff like bonds or currencies. If you're going big and testing your strategy on a bunch of different things, pick ones that don't usually move in the same direction at the same time. This helps you figure out if your strategy is a one-hit wonder for a specific type of investment or market scenario, or if it's versatile enough to work across the board. This will allow you to see if the strategy is suitable for multiple instruments, or if you need to focus on only one asset class or one selected investment instrument. If done correctly, backtesting is a helpful analytical tool that can help you find the right strategy. At the same time, however, its results should not be overestimated, and you need to remember that it is not a tool to help you predict the future. So guys, keep that in mind and trade safely. My name has been Oliver, thank you for watching, and have a great one. If you'd like to get in touch with us, the links are in the description, or you can visit our 24/5 live chat. Thank you for watching this video, and I will once again see you next week. Have a great one.